Welcome to today's short video. This is a little bit of a soapbox issue of mine. Entries are very sexy. People like the indicators, all the colours on the chart, etc., etc. And so it's all about entry for many people. Those of you who've been in the market for a while know that it's not all about entry, that exits are as, if not more important than entry. Really, the purpose of entry is to increase the probability of a trading idea going in your desired direction. You've heard me talking before about the idea of high probability trades, and of course that's one of the reasons we like Hawkeye as software, because it gives us that. But that's entry's only purpose. Your profit, your real deal dollar impact of those entries is felt on exit. It's necessary for determining profit, and it's necessary to minimize loss to within whatever your tolerable limit is, along with position size, in which we've talked about previously. In terms of your trading plan, it's not enough to simply say your exit will be determined by a specific indicator. You should have as detailed a system for exit as you have for entry. If you haven't, you need to do some work on it. It's really as simple as that. And there are two types of exits. There are profit-taking exits. We've got our trail stop. So as the underlying moves up, then we trail our option stop up, and that might be based on the underlying, or you might do it on an option limit order depending on your particular preference. You should also indicate where you might tighten the stop beyond that of your norm. If we're using the trend dot, the Hawkeye trend dot as a stop, which in many cases we do, there may be occasions where we tighten the stop even closer than that. So for example, if it's a bought call trade, something's getting close to resistance, then we know it's called resistance for a reason. There's a fair chance it may bounce off that, so we may tighten the stop accordingly. We may set a profit target, and again, in the same situation, we may set a profit target just below a key line in the sand, close to a pivot high, knowing that we can always get in again. If we've taken something off the table, we can always get it again, knowing that it's a confirmation of a continuation of a trend. And the fourth I've put in brackets because I don't use a staged exit. And by that I mean you exit half of your contracts here and then maybe take another half that are left off the table when it hits another point. I've not found any evidence in my trading that actually benefits me. From my trading, it's an exit is an exit. You need to find your own groove with that and test it accordingly. Our loss minimizing exits are twofold. First of all, obviously we've got our initial stop should it turn around and go the opposite way the following day. And then we've got what we call an event stop. And this is based on one of three factors. We've got a time stop, i.e. when time decay is starting to hurt the position beyond that of a move up in the underlying. So, for example, with a bought call, we'll usually exit if there's less than 3 weeks to expiry, and when time decay really starts to kick in. Our fundamental events, so if there's a big data point, we may either tighten the stop or we may just take it off the table. So if there's a non-farm payrolls tomorrow, we're already in 70, 80, 90% profit on our position. We may just take it off, knowing that we can always re-enter if subsequently it's looking good. And the third type of event stop is what we call a personal stop. And this is really all about you. This is about you not being in the best place to make trading decisions. So if that's the case, if there's things coming up in your own world, then don't be shy to take things off the market. So that's exits. Your trading plan should have all of these things in it related to each strategy that you trade. You've got a mission ahead of you now to go and check in with that, make sure you have got all of these things in place, and if not, then obviously put them in. We'll see you again soon.